Hi everyone, welcome to this month's edition of Midweek Market Update. I'm Ashley Rouster with Victory Fiduciary, and today is going to be a very technical day. So I have a lot of charts. I'm really excited to be able to kind of get in and show you what markets have been doing, what we can possibly expect from markets in the future, kind of as a result of history and just kind of what we're seeing within the charts. So as I started to do my research this month for my video, I realized that there's just a lot of really good information that I think investors should be aware of. So we're going to kind of get into just kind of all these charts, taking a look. And so it's kind of a double-edged message here today. So the first message is certainly markets are very overstretched, very overbought, at least in the short term. I'm going to kind of show you that. Also, interesting about the narrow leadership that exists within the indexes, particularly within the S&P 500 and the Nasdaq. And I'm going to show you that specifically, that while it looks and appears as though these indexes are having very strong starts to the year, when we kind of go under the hood, it's literally 7 companies that are propping up these indexes. And so that really should be kind of a message of caution, certainly for investors, because I'm going to show you, it's interesting, if you kind of take those off of the table, most investors probably have negligible returns right now year to date as a result. So we're going to kind of get into that, get into the fact of why things are so overvalued and overstretched kind of at this time. And as a reminder, you can only stretch a rubber band so wide before it will eventually kind of snap back to where its median is. And so first thing that we're going to just kind of talk about here, so this is interesting. So this is the S&P 500 cap weighted versus the equal weight. So the equal weight holds equaling positions of all of the underlying stocks versus cap weighting that allows it to kind of grow out of proportion. And so this is again showing us those 7 names, which I'm going to show you specifically who they are in the next chart. But when we look at the S&P being up 10.8 year to date as of the middle of June versus the equal weight being up 1.6, I mean, that's a huge divergence, and that's something that investors need. It's not necessarily actionable that we need to do anything, especially if we have exposure to these cap weighted areas, but the thought process is just kind of, hey, we need to kind of have some caution and have some realistic expectations, because again, this is a huge divergence when we look at cap versus equal weight within the indexes. Now, what we're going to look at here is, so the AI stocks, so Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia. So if you look at what these stocks have done versus what the S&P 500 and the Russell 2000 have done this year without them. So we take these stocks out, kind of cut them out of these areas, put them in their own, and you can see again these 7 names are having a huge year, and as a result they've been propping up some of the other indexes accordingly. So the Nasdaq also holds positions in these areas, and so the Nasdaq is even more concentrated, and so the Nasdaq has had an even bigger run than the S&P 500. But again, you can see huge divergences between these 7 companies and what the other indexes have been able to do. Again, not necessarily actionable, but something to kind of, we need to be cognizant of, and as we kind of look forward in terms of decision making, it should at least kind of be on our radar. So again, the S&P 500, if we took the top 10 stocks, so this is just another stock kind of saying the same thing, if we took the top 10 holdings out of the S&P 500, including the 7 that we just discussed there, the S&P 500 would be up 0.5% year to date versus being up just over 10% year to date as of right now. Again, that's a huge divergence. That's telling us that there's not a lot of, we call it breadth within the market. So markets are being propped up in a very narrow field right now. So again, just very interesting as I kind of got into doing this research. So this is actually, I thought this was a really cool chart here. So when you look at what markets have, what different companies have done in the S&P 500, you know, S&P 500 is up 10% year to date. You'd expect to see a whole lot more green on this chart than what we're seeing. But again, our big names, Apple, Microsoft, Nvidia, Google, Meta, Amazon, Tesla. So again, these same names that we've been hearing over and over again, you kind of take those names off of this heat chart here, and it's a whole lot of red, and it's a whole lot of neutral. So again, without these names, you take them out, and again, it's just showing us this narrow field of leadership that we're having in markets right now. And so it's kind of a matter of, does everything else just kind of need to try to catch up? These areas eventually are likely going to cool off. So what does that kind of mean for markets moving forward looking, at least for the second half of the year? Something else, particularly because we've spoken about in previous videos, the fact that we are now in what's considered the weaker parts of the year for the stock market. So I wrote a blog about sell in May and go away is an adage where it kind of speaks to the fact that markets typically cool off, particularly over the summer, and then they don't kind of really tend to heat up again until October, November, and then December leading into the Santa Claus rally. And so in this weaker part of year historically, what will that mean when we see markets having such narrow leadership? And so I'm going to talk to you in a few minutes kind of about our take on that, because we've done a lot of research looking back kind of historically at what areas do well during these weaker periods of the year. And I'm going to tell you, it's typically not necessarily those big tech names. So here, again, here's a chart looking at the S&P 500. And so just a couple of interesting points that I wanted to be able to make here regarding this. So again, this is looking back from the beginning of the year. And so the blue line, as you can see, is the S&P 500. These orange lines are called Bollinger Bands. And so they really kind of look at the upper and the lower end of standard deviation of an index. And so we can see we have our upper, we have our lower standard deviation. So what's interesting about the Bollinger Bands, which I just kind of recently learned about, began to study, is that typically when we reach these periods of time where we get outside of an upper or a lower limit of the standard deviation, we can kind of almost expect to see a reversal back to the mean. And so here you can see we got above our upper limit, and then we had kind of a decline. Then we kind of bounced off of here, came back up to the middle, came back down. Then the next time we closed up outside of our Bollinger Band here, we didn't have a huge sell-off like we had done previously. We just kind of traded in some consolidation there, and then the same thing. So the point being is that when we look up here, yesterday we did just close just outside of our Bollinger Band for the upper limit. Now, does that mean that we're going to have a reversal to the mean back down to here? Not necessarily. We could absolutely just kind of begin to trade in some consolidation to kind of burn off some of that steam. Now, adding to that fuel to the fire here, RSI is up above 70. So we know typically anytime our relative strength index gets above that 70 number, we can expect to typically see some sort of a pullback. I wouldn't be surprised to see a pullback of up to 3 to 5% as extended as we are right now in the short term. And why do I make that statement? It's just because I think it's helpful as investors for us to kind of have a wide view lens, so to speak, of kind of what's going on in the markets, because I don't think that having a short-term pullback in the long run necessarily is a negative. I think it's something that the markets need. So if we can kind of look at like, okay, all right, we're finally getting to burn off some of that excess, which will then set markets up to go ahead and again attempt to achieve new highs again. Just knowing kind of what we do about where we are. So we have narrow leadership within particularly the S&P. We're very extended with relative strength. We're kind of extended, again, we're extended when we look at the standard deviations of trading. And so we're kind of setting ourselves up there for the potential. Now here, another interesting chart that I wanted to talk about. So here we have the S&P 500, and then here we have small caps, mid caps, and emerging markets. And so if you were invested in anything other than the S&P 500, you've probably had either a neutral or negative return year to date. So again, just kind of showing you that those 7 companies that we talked about, and again, the same goes for the Nasdaq. For simplicity, I decided to just carry the S&P 500 through the presentation today, but the same has gone on with the Nasdaq in terms of those large 7 names having a high cap of ownership and leadership within the index, causing indexes to kind of take off. But to kind of just put it into perspective, if you are invested in anything else other than just the S&P, the Nasdaq, QQQ, those names, then you've probably had a much more muted or even a negative return in portfolios. So here, again, the S&P 500, all I'm trying to show here is that we've been kind of trading, we have kept our bullish chart, we're kind of in a bullish sentiment still, trading though within a fairly narrow area, especially here. So we're about to hit that the upper channel of the trend. So we've been kind of keeping with this bullish trend moving. We kind of bounced off the bottom of the trend here that remained intact, and so we've had a pretty big run, and so I would not be surprised again in the short term to see some sort of cooling off, some sort of a pullback within the S&P 500 as well as the Nasdaq. And so it'll be interesting to kind of see then when that happens what will happen to some of those other areas of markets. And so I promised you I would talk to you a little bit about, you know, historically what have we seen happening with other areas of the market in historically weak areas. And then, you know, one thing I just want to talk about from a fundamental standpoint, which is going to kind of lead me into my the end here. So we are seeing inflation continue to go down month over month, year over year. And so this is telling us that it's what the Fed, the intentions of the Fed, they are working, okay, as we see inflation finally coming down after peaking last year. Still quite elevated though from where we were. Looking back 10 years. So still probably have some work to do. Today is Wednesday. The Federal Reserve is going to be meeting again. The expectation is that they will likely pause rate hikes for this session. But I wouldn't count them out for saying that there's still going to be more work to be done in the future. And so I think markets have already likely priced in the fact that with the inflation numbers and the other fundamental data that's been coming out, that we'll likely have a pause at least for this meeting. But again, so I don't expect markets to do anything real crazy either way as a result of the meeting, unless Jerome Powell comes out with a more aggressive tone regarding what will need to occur to allow inflation to continue to come down. So otherwise, I think what's been priced in is that the Fed Reserve is going to say they're pleased so far, we're going to take a break, but that there's probably still some more work to do. And so when we're in an environment like we are right now, so we have a lot of narrow breadth within the indexes, we are in the seasonably weaker portions of the year. Our investment committee did a whole lot of work to kind of determine what areas consistently were able to beat the S&P 500 in the weaker areas. And what came out far and right is that there were 5 areas of the market, and so that was consumer staples, it was real estate, it was industrials, it was utilities. And so these are your defensive names. These are your areas. Now again, the other 2 areas as well that came up on this screen was looking at large cap growth and large cap blend. Far and away beat all of the other areas. And so these are areas that, you know, we had already been previously looking at and had made some additions to portfolios ahead. And so it was just interesting. So we kind of took all the technical data that was already out there that was pointing us that these were likely areas. Now, we do not currently have real estate or utilities in our portfolios because they still weren't the strongest out of some of the other areas. And so even though they were stronger than the S&P historically over that time, we decided that we were just going to pick the top 3 names to add into our portfolios. And so that's what we've done. But so those are areas that, again, historically, history never perfectly presents what's going to happen in the future, but we tend to see mirrors of it. And so again, we're kind of rolling with that theme again. So those are some areas that investors may want to consider in this weaker portion. Again, who knows what is going to happen. I expect that we're going to see absolutely some sort of at least consolidation, if not pullback. But I wouldn't panic if we see a 3 to 5% correction in the markets, because it's really, we can only stretch ourselves so far before we have to kind of come back to reality, so to speak. So I hope that helps to kind of explain what's going on within markets right now, what's going on within the indexes. If you have any questions about what we talked about today, you can always email me at ashleyer@victoryfiduciary.com. Or you can check out our website, victoryfiduciary.com. All of my blogs, as well as all of our other previous videos, are located there. So we thank you so much for tuning in, and we'll see you next time.